All roads lead to crypto stablecoin issuers swapping long dated bonds to keep rates down, stimulate the United States economy, and send Bitcoin to many, many, many millions of dollars. Let's watch this. 1.5x.
The biggest risk to the United States economy was never the AI bubble. It was never China, and it was never the orange man in the Oval Office. It's something much more boring, and it's something you've likely never heard about, unless you've gone deep down the finance rabbit hole, and that's exactly why nobody's paying attention to it. Because if you've been wondering why mortgage rates refuse to fall, why stocks randomly freak out every few months, and why the Federal Reserve can talk about cutting rates but financial conditions still feel tight, the answer doesn't start in Washington. It starts in Tokyo, and more specifically, in the most boring asset on Earth, Japanese government bonds. Because the country best known for attracting American weebs has also been the duct tape quietly holding the global financial system together for the past 30 years, and that duct tape is starting to peel. But to understand why Japan is so important, you first have to rewind to the early 90s. Because 30 years ago, in 1992, Japan's asset bubble burst, real estate collapsed, equities collapsed, and
We learned about this.
Japan entered what became known as the lost decades. It was a 3-decade-long period of being financially f***ed. There was no real growth, no inflation, and no wage expansion. It was like the economy hit pause, and nobody could find the remote. So the Bank of Japan did what central banks do when they're out of options. They cut rates to zero, and then they cut rates below zero, and then, when that wasn't enough, they introduced something called yield curve control, which sounds like a Marvel villain, but actually just means, we're going to cap long-term bond yields, whether the market likes it or not. Basically, the Japanese government superglued interest rates to the floor, so for decades, Japanese government bonds yielded pretty much nothing, and that created massive problems for Japanese investors. Because imagine you're a Japanese life insurer, pension...
I watched this video about this documentary about the Japanese bubble in the 80s. They called it window dressing, I think, where banks were required to give out X amount of money in loans annually. And they wanted to stimulate the economy and fucking catch up to the US. And then every year they would increase the amount of money. And eventually the banks were like, guys, we don't have any other applicants to give this money to. We have no one else to give the money to. And they're like, figure it the fuck out. So when you have no one else to give good loans to, what do? Well, you give bad loans. You give good loans to bad people that don't deserve it. Oftentimes, people will get more money than they asked for. They were just ripping money into the economy. And then they made this law. If you were a company and you were trading stocks with your balance sheet, there was no capital gains. Everyone was getting these basically free loans with no interest, more than they asked for, and they were ripping them into stocks that were going up only because everybody else was ripping them into stocks. And the biggest companies in Japan at the top, like Toyota and these other companies, were making more money speculating on Japanese stocks than they were manufacturing cars. There was this take I read that there was a multi-mile radius around Tokyo that was of real estate that was worth more than all of California. And Tokyo itself was worth more than the entire United States of America at the Pico top of this bubble. Like, it was fucking insane. Up only. And then, boom, they fucking hiked rates to a ridiculous percent. Like 5, 10%, 15%. Jacked rates in everybody's face. Destroyed the economy. And then to like re-stimulate, they sent it back to zero. And everyone in the US has been ripping this Japan yen carry trade for the last like 30 years.
Fund, or even a bank. You have a $1 billion investment portfolio, and your domestic government bonds are paying you 0%. This pretty much leaves you with two choices. 1, accept no return on your cash, or 2, go shopping overseas. And they chose option 2. So Japan entered a multi-decade-long global shopping spree that led them to become the largest foreign holder of US treasuries, one of the largest buyers of US mortgage-backed securities, and the world's largest net creditor nation, which is just the formal way of saying Japan became the world's ATM. And it's not because Japan just loves sending capital to America, but it's because the math made sense. And here's how it worked. Meet Bob. Bob wants to start making some money through investing. So Bob goes to the Japanese markets and borrows money in yen at near zero interest rates. Then Bob converts that yen into dollars and buys US treasuries that yield 4%. And after hedging costs and fees, he pockets the spread. And that's what became known as the yen carry trade.
Bro, do you understand what he just said? Listen to this. How fucking ridiculous this is.
Largest foreign holder of US treasuries, one of the largest buyers of US mortgage-backed securities, and the world's largest net creditor nation, which is just the formal way of saying Japan became the world's ATM. And it's not because Japan just loves sending capital to America, but it's because the math made sense.
Listen to this. Listen to this. Listen to this.
And here's how it worked. Meet Bob. Bob wants to start making some money through investing. So Bob goes to the Japanese markets and borrows money in yen at near zero interest rates. Then Bob converts that yen into dollars and buys US treasuries that yield 4%. And after hedging costs and fees, he pockets the spread. And that's what became known.
You could buy Stretch. Imagine borrowing yen at 0% interest and then ripping into Stretch at 11.5.
As the yen carry trade.
And then taking loan out against your Stretch to borrow more money in Japanese yen and then buy more stretch.
Investors would borrow in yen at near zero interest rates and then invest in foreign assets that yielded higher returns. And when investors' borrowing costs are near zero, they don't just buy treasuries, they buy tech stocks, they buy real estate, and they buy into emerging markets.
Tyler, it's a
Basically,
new
if
video.
it's got
We
a
haven't
pulse
watched
and
this.
it yields more than
This is a
0%,
new video.
they'll buy it. And that's why for years, this trade became one of the largest sources of global liquidity. At its peak, the yen carry trade was estimated by some banks to be in the trillions. It was like the global markets were running on Japanese Wi-Fi. But the problem was that the entire trade relied on one assumption that held everything together, that Japanese yields would stay near zero forever. But in 2024, that assumption broke when the Bank of Japan ended its yield curve control policy, and Japan raised interest rates for the first time in 17 years, and then they raised them again. And immediately following that second rate hike decision, the S&P 500 dropped 6%, and Japan's index, the Nikkei 225, plummeted over 12% in a single day, marking its worst drop since 1987. It was a clear signal that markets were officially spooked. Because when Japanese yields rise, two things happen. One, borrowing in yen becomes more expensive. And two, hedging currency risk becomes more expensive too. And suddenly, the free money trade isn't so free anymore. And that 4% US Treasury Bob was looking at doesn't look so good anymore. And this was the beginning of the end for the yen carry trade. Because now the math had flipped, and the trade was no longer a no-brainer. And when the math
Imagine I knew what I knew when I was old enough to do this like 10 years ago. What?
flips, the capital flows flip too. And the money that flowed out of Japan for decades was starting to
I would be so fucking tits leverage that you would see a crash in markets that you didn't even think were mathematically possible.
return home. And this is what's called repatriation, and it's one of the biggest threats in global markets today. Because investors are starting to realize the uncomfortable truth. The cheapest source of global liquidity for the
24.
past 30 years is no longer cheap. But here's why it actually matters. Because for decades, Japan wasn't just some random buyer of US debt. They were one of the most consistent, price-insensitive buyers of long-term treasuries. And the yields on those long-term treasuries? Well, they aren't set by Jerome Powell. The Federal Reserve controls short-term rates. But the 10-year, 20-year, and 30-year? Well, those yields are largely determined by supply and demand. And the problem is, everyone's staring at the wrong lever. And here's legendary investor and founder of the
Ugh,
world's largest hedge
God.
fund, Ray Dalio, to explain it.
Get him
Watch
off
the
the
bond
screen.
market. The bond market is the basis, it's the backbone of all markets. It is the risk-free, meaning default-free, probably default-free.
Ray Dalio has called all 5,000 of the last 2 recessions. It's like, nah, he's goated. I can't lie, twin.
Interest rate that determines what all asset returns are going to be. And when
He's the
there is a
goat.
breakdown of
He's
the
just so
supply and
doomer.
demand picture for the bond market, you see a certain type of market action. You see long rates rising relative to short rates. You see the currency go down. You see gold go up because there's a movement out of that bond market because there's a supply and demand imbalance. When that happens, that raises interest rates. And it puts the Federal Reserve and other central banks in a bind.
So while everyone is hyperanalyzing Jerome Powell's press conferences like it's a new GTA 6 trailer, they're looking at the wrong end of the yield curve. Because while the Fed has some indirect influence on long-term rates, what they really control is short-term rates, the overnight rate. But the long end of the yield curve is driven more by supply and demand. And when you add in the
Welcome.
fact that the United States is running
Welcome.
trillion-dollar deficits annually, even a slight reduction in demand matters. Because the Treasury has to issue massive amounts of new debt every year just to keep the lights on in the economy. And as this debt issuance keeps growing, someone has to absorb it. And for the last few decades, Japan was a key part of that absorption machine. Japan backs out. We are totally f***ed. Because if one of the largest historical buyers of United States Treasuries stops buying, then yields have to rise to attract new buyers. And that's how supply and demand shape long-term bond yields. But that's also how you can get a situation where the Fed cuts the federal funds rate, short-term yields fall, but long-term yields stay elevated, and that's how you get what's called a steepening yield curve. And if this happens and long-term rates stop cooperating, then it stops being just a bond market story, and then becomes an everything story. Because when analysts build models to value stocks, they discount cash flows using long-term yields as a baseline. And when long-term yields remain elevated, the present value of future cash flows in these models decreases, which means valuations compress and stocks trade at lower multiples.
That's actually a sick take. Tether will buy what Japan won't. That's stable coins. Yeah. New buyer has emerged.
So even if earnings are fine, the price investors are willing to pay for those earnings changes. And that's why markets can suddenly feel unstable, even when the headlines look calm. But it doesn't just stop at the stock market, because the 10-year Treasury yield isn't just some nerdy number on Bloomberg. It sets the price of money and is the foundation of nearly every asset valuation. And mortgage rates are another example of this, because like stock valuations, mortgage rates are largely anchored to long-term Treasury yields. So if the 10-year yield doesn't meaningfully fall, mortgage rates don't magically drift back to 3%. So the Fed can cut the federal funds rate all they want, but if global demand for Treasuries weakens, then the long end of the yield curve stays pinned. And when that happens, mortgage rates stay high, housing affordability stays strained, refinancing activity stays muted, and home transactions slow. But it's not just mortgage rates and equity valuations, because if you zoom out even further to corporate credit, it's the same story. If you remember back when capital was cheap in 2020 and 2021, when rates were suppressed, companies were issuing debt like it was Black Friday, and interest rates were 90% off. And when companies have access to cheap financing,
Glaze.
we see increased deal flow, higher valuations, and more activity. And that's because credit is the bloodstream of the corporate world. But if borrowing costs stay elevated, we see the opposite. We see risk appetite fall, growth slow, and and capital tighten. And this is the main point of the video, because for 30 years, the United States benefited substantially from being on the receiving end of the world's largest carry trade, and now that trade is unwinding. And as Ray Dalio said, the bond market is the backbone of all markets and the interest rate that determines what all asset returns are going to be. And what we are currently seeing is a tangible catalyst reshaping the foundation of the bond markets. And there's a reason why traditional financial media is ignoring this. It's because it's not clickable, and because it wouldn't trend on Twitter. Nobody wants to hear, let's discuss the cross-currency carry trade and how Japanese institutions are reallocating capital.
fucking
Because
clicked
that
on it.
requires patience and nuance and more brain cells than doom scrolling allows for. Instead, people want inflation, they want AI, and they want whatever Nvidia did last week. They want the topics that are visible, loud, and create headlines. So instead, the narratives become dramatically oversimplified to, if the Fed cuts rates, financial conditions will ease. And that's not necessarily true. And that's the lie we're being sold. That one rate cut fixes everything, that liquidity is automatic, and that someone, somewhere, will always show up to buy our debt. But what if they don't? And what if the largest foreign holder of US Treasuries decides to take a step back? Well, then you see global liquidity tighten, and liquidity is the oxygen in markets.
Okay, so basically saying that we don't have a marginal buyer of our bonds anymore because the yen is dead. Is it actually just stable coins getting approved? Is it actually just stable coins? Infinitely bid bonds forever? Roughly how much money was being spent on buying bonds from the yen carry trade? About 10 to 20 trillion. How much can Tether spend buying bonds right now, 26, and including year-over-year growth? Holy shit, I get it now. I fucking get it now. Oh, I get it. I get it. Oh my God, they have to rip stable coins. Oh man. Wow. That means a huge buyer of our bonds are gone because they jacked rates. If that buyer doesn't get replaced, what happens to U.S. economy? It's not dead. Less demand for treasuries. No one wants to buy our debt. Okay. Wait. Yields stay structurally elevated. 10-year doesn't go back 2 to 3%. This reprices every long duration asset. Housing, growth stocks, private equity. It's not a crash event. It's a slow suffocation. Before we talk about replacing, let's just assume yen carry trade is dead and there's nobody left to buy. What happens to economy? Yields spike hard. Mortgage rates follow. Housing market seizes. Nobody sells. Nobody buys. Government interest explodes. Oh, the interest gets so bad. Private equity is uninvestable. Sovereign debt spiral. Okay, wait. So now enter stable coins. Stable coins are obviously the next marginal buyer to replace. So basically the economy's cooked. Interest rates get so ridiculous. There's no one to buy these bonds. Long dated bond yields go crazy. And then nobody can afford to borrow anything. Stimulation in the economy gets fucked. Money stops transacting. I have that right? Like, let's assume there was no one came in to buy the hole that's left of the carry trade dying. Yields go crazy. Nobody can afford anything. Nobody can borrow money. Stimulation, growth stops. Expansion stops. How much buy pressure do they currently provide and to bonds, and what has to happen for that to get to 10 to 20 trillion? Oh, they passed the Genius Act. Okay. So Tether does 150. So they do like nowhere close. The Genius Act is legal stablecoins in the United States of America. So we basically have to 100x the stablecoin supply. So we have to 100x the stablecoin supply. Is that why the Genius Act was passed? And what are the trades there if this happened? That's exactly why. Oh, we're connecting dots. U.S. government has a bond demand problems, and stablecoins are the most elegant solution they've ever found. You get a private sector entity that must by law buy your debt. Funds it through global dollar demand, and it requires zero government balance sheet expansion. It's a backdoor QE mechanism that doesn't show up as money printing. Because instead of the government buying fucking bonds with QE, keeping rates down, yields down, expansion high, stablecoins do it because that's how they fucking get rich. The Genius Act is fiscal policy disguised crypto regulation. Trump admin isn't pro-crypto because they like Bitcoin. They're pro-stablecoin because they need buyers of treasuries. As China, Japan, and others reduce exposure. Stablecoins are a replacement mechanism. Oh my God, I get it. Scott Bessent understands this. I fucking get it. The trades. Circle, Coinbase, Visa, MasterCard. Oh, wait. What did MasterCard do today? I don't know. How about acquired stablecoin infrastructure startup for $1.8 billion? If stablecoins tend to 50x and become structural treasury buyers, long end yields stay more controlled than the bear case suggests. Why is it good for the economy if long yields stay down because stable coins are swapping bonds? Long yields are the price of money for everything in the economy. Mortgages are cheap, corporate debt is cheap, government interest expenses stay manageable, equity valuations stay elevated, dollar doesn't spike violently. So how do we print 100x more mint, I guess, stable coins? Yeah, they get minted. You know what I meant. Global dollar reserves coming on chain. Oh my God, BlackRock tokenized everything. Emerging market adoption, banks issuing stable coins, tokenized market money funds, BlackRock. Oh my fucking God. What happens to Bitcoin price if we mint 100x more stable coins? Directionally up massively. Stable coins are the primary armament of crypto. Wow. How beautiful was this? This is what it's all about. You know? So now we understand the importance of genius. No, not clarity. This is genius. Genius already passed. They basically said this is what you have to do to make it legal to mint a stablecoin in the US.